Hello again, Module 4. You've made it this far. We're going onward and upward. We're going to be talking today about financial analysis and ratios. Also, we'll talk about horizontal analysis, known as trend analysis, and vertical analysis, known as common size analysis. This is the heart and soul of reading financial statements and in making decisions and interpretations and understanding. We said the financial statements paint a picture of a company, and this analysis helps you understand that company and allows you to compare them to other companies and organizations, both in the industry and outside the industry during same economic time period. So what's our goal initially? We're going to start with ROA and ROE, return on equity and return on assets. We've had some familiarity already. We've actually been calculating them already in previous modules. So we're going to take a closer look. So what's ROE about? ROE, return on equity. Remember, return, net income, earnings, net profit, all the same term, all the same number, but your bottom line income statement, how much you made, how much is left over after paying all the expenses, deducting all losses, adding all gains, that's what's left. So our net income is in the numerator, and you can't forget we need to take average share of stockholder equity. Average equity, well, we have a period of time for net income. We start, we end, we got usually a 12-month period is how we analyze. If we took a stockholder equity just from the balance sheet at one point in time, it would distort the picture. The advantage is taking a time period for net income and averaging beginning and ending stockholder equity, add beginning to the ending, divide by 2, and there's our average. So ROE measures return from the perspective of the company stockholders. Based on the amount invested by stockholders, what's the return? What's the profit percentage? When we look at ROA, same concept of income for a period of time, usually the year, over beginning and ending averaged total assets. So if you bought all these assets, not just invested your money, but if you bought all these assets, what will your return or profitability be? Equity is almost always going to be lower than assets, correct? So if we look at our formula, if our equity is lower, that makes this return higher. And it's kind of logical, because when you invest in a company, you can have debt or you have equity. If you put up this amount of money and you have this amount of profit, that's spread across a smaller number than if you have your total assets and the profit spread across. So that's why our return on equity is almost always going to be higher. Sometimes it's negative income or losses, net losses, and you have a negative return on equity. So we're going through and we're seeing that our return assets is, again, enterprise level, entire company, both profitability and assets, numerator, denominator. The company must be profitable and manage assets to get a high return on assets. So that's what we're looking for. We're ultimately looking for those returns. And analysis encourages managers to focus on both the income statement and the balance sheet. You can't just buy a whole bunch of stuff and go forward without balancing it out and say, well, what's the return on all this stuff? How much if I invested, if I bought all this stuff, what would I make? Versus if I just invested and then borrowed somebody else's money, what would I make? So we're going to take a look at Standard & Poor's S&P 500. We're going to pick a company, and in that company, we're going to do a little bit of analysis. In this case, we'll use Boston Scientific. So what is the Standard & Poor's? 500 large cap, I think large cap companies, publicly traded companies, and they must be profitable for the previous trailing 4 quarters, averaging the 4 quarters and seeing that the profit. They currently account for about 75% of the US stock market, about 3/4 of the market, US-based companies. And the Dow you probably heard of is only 30 stocks, where the Standard & Poor's is 500. So the Dow Jones, DGIA, Dow Jones Industrial Average, or the Dow. But we'll use the Standard & Poor's for our analysis. So let's take a look at a financial statement of Boston Scientific. So we see sales, net income, we see total assets, total stockholders' equity. And we're seeing for 2 years. As you recall from Edgar, we get 2 years of balance sheet data and 3 years of income statement data. So sometimes if we need to do a previous ROE or ROA, we're going to go to a previous 10K to get another year. So we'd have 17 and 18, 2017, 2018 on one 10K. To get 2016 and 2017, we have to go to another 10K. So we calculate return on equity here. We got 21.24%. So is that good or bad? That's the question. The ultimate answer, it depends. Those famous two words, it depends. What does it depend on? Well, if you're comparing Boston Scientific to other high-tech organizations and they're 30% return on equity and 25%, and you're 21%, what do you think? Sure enough, the higher percentage return is usually better. The lower return is usually not as good. Now, the average return on equity for a 4-year period, 2014 to 2018, 13.5 to 15.6%, averaging all of the Standard & Poor's S&P 500 together. So that gives you an indicator. And again, these numbers are all relative. Let's take a look at Boston Scientific's return on assets for the same period. We've got a ticker symbol BSX. We've got the net income divided by the average assets, 8.35%. Return on assets. And you'll notice that, yes, ROA is lower. We've got the 21% versus the 8% of return on assets versus return on equity. Is that good or bad? Again, it depends. It depends on competitors. It depends on the marketplace. It depends on the economy. So we're looking at 17, 18, and we're saying, well, how's the economy doing? If you were looking at 2007, 2008, you probably would not have very high returns. So this gives you an insight into where they're at. Now, not the average, but the median return on assets for 2018 was 6.1%. So we're doing better than the median. And the range was from 5.2 to 6.1 during that same time period. So let's go one more test. I want to go into Edgar. I'm going to go through by opening up Edgar as you have before. We're going to review it. We're going to take a look. And when we do that, we're going to find that we can analyze. Go to the SEC website. And when we have it loaded up, I'm going to select company filings. And then we're going to go ahead and search by company or fund name. And let's go pick a company. Let's go ahead and take a look at, maybe we wanted to choose, who we want to work with. Well, let's take a look at Target. Or Target. Okay. So we've got Target, TGT. I'm going to do ticker symbol. I prefer ticker symbols because I jump straight to the company itself. You might have other targets. You might have target investments, but we're going to go ahead and jump in. And if we look on Target, we have, that's the challenge. Let's try that again. We have Target, TGT, Target Corporation. And if we jump in, we've got to go to this classic version in the upper right-hand corner. Well, that's where we want to make sure to get our interactive data. And then we go ahead, and the filing type is a 10-K, not a 10K, but a 10-K. You could do a 10-Q for quarterly projections analysis, but we usually use the annual report. And then when we go to financial statements, notice they have a statement of operations, a statement of I can speak straight. Well, good. A statement of comprehensive income. I'm going to actually magnify this a little bit so you can see it a little bit better. And we're going to go into that portion of screen thing. And we're going to say, wait a minute, if I wanted to see the income statement, it's not a statement of comprehensive income. That confuses us all, where you start with net earnings. Income statement does not start with net earnings, does it? It ends with net earnings usually. And then we have other things. We have pension benefit liabilities. We have currency translation. That doesn't sound right. And we're looking for an income statement. If we go to statement of operations, there we go. Starts with revenue and cost of sales, or cost of products sold, or cost of goods sold. SG&A, we get all this good stuff. So if we're going in, we're saying, great, I'm going down bottom line. I go right before my earnings per share number. That's where I find my net earnings. I got all this EPS, earnings per share. By the way, earnings, again, same as net income, same as net profit, same as net earnings. So we've got 6946 in the numerator. Okay, so I'm going to go ahead and share the screen, pop it on a whiteboard for us. We've got 6946 is net income. Now I'm going to go back and we're going to go take a look at what the average assets are. So where are we going to find that? Let's go back to our analysis. We're going to go ahead and we'll go on to our share. And where's the balance sheet on here? We got a statement of cash flows. That's obviously not it. We got a statement of shareholder investment. That sounds like equity, doesn't it? And parenthetical. The only ones left seem to be something called financial position, a statement of financial position. Well, let's look at the one that says parenthetical first. And that's kind of funky. Parenthetical statement of financial position, common stock, shares authorized, par value, shares issued. This is some good information, but it's only a piece of what we need. This gives us a little bit of information about the equity section. But if I go to my statement of financial position, there we go. I've got assets. I've got liabilities. I've got equity. And I have shareholder investment. Okay, that's the same thing for equity. Again, we're not trying to confuse people on purpose, but we have lots of names for the same thing. So if I'm doing a return on equity, I need average equity. What's my total shareholder equity? There we go. I got 12.8 and 14.4. Again, we're looking at 2 years. This is January 29, 2022 and January 30th, 2021. So if we're going down here, there's our two numbers. Now, I could go over to our whiteboard and take that average and try to calculate, but I'm going to make life a little bit easier for us. I'm going to actually go in, view Excel document here. This is probably what you're going to want to do when we do our analysis and when we do your projects. And you're going to pick up the spreadsheet at that point. So we're going to open this up. I'm going to open the spreadsheet, and it's going to go through, and oh, that's interesting. We've got a budget for Peak Grant, the trip we're taking. So that's kind of cool. But we're going to go through and take a look at our financial statements. And we're going to go out and say, great, here's our cover page. Here's our audit information. Oh, EY, my alma mater, out of Minneapolis, Minnesota. That's where Target is based. So we have our statement of operations. And sure enough, we get that same number here, 6946. So I'm going to go ahead and go to my, let's see, this is my statement of comprehensive income. There's my statement of financial position. I'm actually going to go ahead and insert a column here. Actually, I need to make this enable editing first. And then we're going to go in and take care of inserting a column. And we're going to go ahead and do a calculation. So I'm going to get my average assets. Okay, how do I get my average assets? Equals that. Parentheses, we'll do it right. Equals that plus that slash 2. And I'm going to have my net income equal, and go over to my statement of operations and take my income number, 6946. And I'm just going to divide the two. If I'm putting it anywhere I want on the spreadsheet, that's where we go. And you say, great, 0. We got a 0 return. Probably not the case, really. We got to worry about our percentage here. And go through and see what it really is. Okay. So my return on assets is 0.132, or if I make it a percentage, 13.2%. Pretty easy to calculate. And then you ask the question, is that good or bad? Well, some say it's a profit. That's great. It's positive. That's cool. Who are you going to compare yourself to? Maybe you're going to look at Walmart. Maybe you're going to look at other retailers. Maybe you look at Sears. Maybe you look at other department stores. Maybe you look at Belk's, Kohl's. Now you've got a basis of comparison. And you can say, well, how are we doing on ROA, return on assets, compared to the other guys? Or how are we doing if we want to do return on equity? Same idea. We'll go down here. We have, now one interesting point I will make here, notice we have current liabilities, total current liabilities here. We do not have total liabilities. I got total non-current liabilities, other non-current liabilities, but I've got to combine. So if I want to find out what my total liabilities are, and I'm actually going to insert a row here just to give you an understanding, because you're going to have to do this sometimes. I want to get total liabilities. The easiest way, rather than totaling like non-current, current, all that good stuff, I just take my liabilities and shareholder equity, I subtract my equity, and there's my total liabilities, 40,984. My total equity is 12,827. Total liabilities and equity is 53. If I do the debt to asset ratio or debt to equity ratio, which we'll see in a little while, you've got to make that subtotal yourself. Do not grab the total current liabilities. I've seen this mistake made too many times. It says, oh, total liabilities, there it is. Well, no, that's just the current stuff. That's just the 1 year stuff. So thank you for listening. We have a whole bunch more stuff to go into Module 4, and I look forward to your participation and hearing more of what we have to offer. Talk to you soon.